Welcome back to the deep dive. Today, we're embarking on really quite a fascinating journey right into the heart of corporate finance. We're talking treasury stock.
That's right. It sounds technical, maybe, but it's fundamental to how companies manage their equity.
Absolutely. And it might seem complex, but we're going to, peel back those layers. We'll take you through the whole life cycle of a company's shares.
From the very beginning.
Yeah, from initial creation through the company buying them back, the repurchase, and maybe reissuing them.
Uh-huh. Selling them again.
And finally, potentially, their permanent removal. Retirement. And we're focusing specifically on the cost method for accounting for all this.
The most common message you'll see in practice, really.
Our goal here is pretty straightforward. Give you a clear step-by-step understanding with, practical insights. Good stuff, whether you're deep in accounting studies or prepping for an exam.
Definitely. It's all about seeing how these transactions flow.
Okay, before we dive deeper, just a quick reminder that this deep dive is based on material from Farhat lectures.
A great resource.
Totally. All the content, examples, explanations, it's all derived from the comprehensive accounting resources over at farhatlectures.com. So if you're an accounting student, CPA candidate, or already a professional, really do visit the website.
Yeah, lots more practice questions, video lectures, detailed support. Really helps reinforce this stuff.
Oh, for sure. Special thanks to Professor Farhat for providing this valuable material for our discussion today.
Okay, so where do we start this journey?
Right at the beginning, to really get treasury stock, you have to see where the shares come from in the first place. Issuance.
The creation moment.
Exactly.
Yeah.
So imagine a company. They decide to sell, let's say, 8,000 shares of their common stock. It's got a $2 par value, and they manage to sell them for $10 a share.
Okay.
So the accounting for that initial sale, they get cash, right? So debit cash. 8,000 shares times $10, that's $80,000.
Cash in.
Then they credit common stock, but only for the par value amount. So 8,000 shares times $2 par, 16,000.
Right, the legal capital piece.
And the difference, that premium over par, $10 minus $2 is $8 per share times 8,000 shares.
That's $64,000.
Correct. $64,000 gets credited to additional paid-in capital, or APIC, sometimes called capital surplus.
And that structure, that initial recording, is critical. It sets the baseline for everything that follows with these specific shares.
It's the foundation. Those shares are now out in the world, held by investors.
Exactly. Now, let's fast forward. The company's doing well, maybe have some extra cash, or maybe management thinks the stock is undervalued. They might decide to buy back some of their own stock from the market.
And that act, buying back their own shares, is what creates treasury stock.
Precisely. There are a few reasons why, as you said. Undervalued stock, maybe they need shares for employee stock options, or they just want to boost earnings per share by reducing the share count.
Lots of strategic reasons.
For sure. And for our deep dive, the key is how we account for this using the cost method. Under this method, it doesn't matter initially if they buy it back for more or less than the original $10 issue price, or even the $2 par value.
Right. The price they pay now is what matters for the initial treasury stock entry.
Exactly. Gains or losses aren't recognized at this point. That comes later if they reissue the shares. So how do we record that repurchase?
Okay. Yeah, this is where it gets interesting, but also kind of straightforward under the cost method. Let's say our company buys back 500 of those shares, and maybe the market price has gone up, so they pay $12 per share.
Okay, paying $12 for shares they originally issued at $10.
Right. So the entry, they debit an account called treasury stock, and they debit it for the cost of acquiring those shares. So 500 shares times $12, that's $6,000.
We debit treasury stock, $6,000.
And they paid cash, so credit cash for $6,000.
It's simple enough. Cash out, treasury stock in, recorded at cost.
And that treasury stock account, it sits on the balance sheet, but it's a bit unusual. It's a contra equity account.
Meaning it reduces total stockholders' equity, like a negative equity account in a way.
Yeah, exactly. It shows that the company holds some of its own shares, reducing the overall equity pool.
And the beauty of the cost method is that simplicity at repurchase. It kicks the can down the road on recognizing any gain or loss. So now the company is holding these 500 shares in its treasury. What can they do?
They've got options. Hold them, reissue them, sell them back out, or retire them permanently.
Let's tackle reissuance first. This is where those potential gains and losses finally surface.
Okay. Let's say things are looking good, the stock price is up, and the company decides to sell some of those treasury shares. Remember, they bought them at $12. What if they reissue 200 of those shares for $15 each?
Okay, selling higher than they bought. $15 sale price, $12 cost.
That's a $3 difference per share, a profit, you might say. For 200 shares, that's $600 total.
Right. How's that recorded?
Well, cash comes in,
Yeah.
200 shares times $15. That's $3,000. So debit cash, $3,000.
Makes sense.
Then we need to take those shares out of the treasury stock account. We credit treasury stock, but always at its original cost. So
Yeah.
200 shares times the $12 cost, that's $2,400.
Credit treasury stock, $2,400.
Okay.
The entry doesn't balance yet.
Exactly. We have a $3,000 debit and a $2,400 credit. The difference is that $600 profit. But critically, it doesn't go to the income statement as a gain.
Right. Transactions in a company's own stock generally don't hit net income.
Correct. That $600 gets credited to a separate equity account, often called paid-in capital treasury stock, or maybe additional paid-in capital treasury stock.
So a full entry. Debit cash, $3,000. Credit treasury stock, $2,400. Credit paid-in capital treasury stock, $600.
Perfect. And that paid-in capital treasury stock account is now holding that $600 gain. Think of it like a little cushion.
Cushion that becomes really important if the opposite happens, right?
Yeah.
What if they have to reissue shares for less than they paid?
Ah, yes. The plot thickens. This is where that paid-in capital treasury stock account really does its job.
So let's say the company needs to reissue another 100 shares from that same batch they bought at $12. But maybe the market's dipped and they can only get $4 per share this time.
Ouch. Bought at $12, selling at $4, that's an $8 loss per share.
And for 100 shares, that totals $800.
So how do we account for that $800 difference? This is where the rules get specific. There's a hierarchy.
Exactly. You can't just immediately charge it all to retained earnings. First, you have to look at that paid-in capital treasury stock account. Do we have a balance there from previous gains on treasury stock transactions?
And in our case, we do. We just put $600 in there from the last transaction where we sold shares for $15.
Perfect. So the first $600 of this $800 loss gets absorbed by that account. We debit paid-in capital treasury stock for $600, wiping out its balance.
Okay, so that takes care of $600 of the $800 loss, but we still have $200 of the loss left to account for.
Right. Since the paid-in capital treasury stock buffer is now empty, that remaining $200 loss does reduce retained earnings. We debit retained earnings for $200.
Got it. So the cushion absorbed as much as it could, and the rest hits retained earnings. What's the full entry look like then?
Okay, let's piece it together. They received cash, debit cash for $400, 100 shares by $4.
Yeah.
They absorbed the loss first via the buffer, debit paid-in capital treasury stock for $600.
Right.
Then the rest of the loss hits earnings. Debit retained earnings for $200. And finally, remove the shares from treasury at cost. Credit treasury stock for $1,200. 100 shares, that's $12.
Let's see. Debits are $400 plus $600 plus $200, $1,200. Credit is $1,200. It balances.
Perfectly. And it shows that interplay between the equity accounts. Those earlier gains really did shield retained earnings to some extent.
That's a really clear illustration. So, okay, we started with 8,000 shares issued, bought back 500, reissued 200 above cost, then 100 below cost.
Meaning there are still 200 shares left in the treasury account from that original 500 share repurchase. 500, 200, and 100, 200.
Exactly. Now, what if the company looks at those remaining 200 shares and decides, we don't want to reissue these, we want them gone permanently?
Ah, the final act potentially.
Right.
Retirement.
This brings us to the retirement of treasury stock, not just holding it, not reselling it, but actually canceling its existence.
And this is fundamentally different from reissuance. Retirement means those shares cease to exist. They're taken off the books entirely, effectively reversing the original issuance for those specific shares. It permanently reduces the number of authorized and outstanding shares.
Okay, so for these last 200 shares, remember, bought at $12, originally issued at $10 with the $2 par, the company decides to retire them. How does that accounting work? It feels like we need to unwind things.
You do, in a sense. It's like you're erasing their history from the equity accounts. It takes a few steps.
All right, let's walk through it. Step 1.
First, you have to get rid of the treasury stock balance for these shares. Since they're held at cost, we credit treasury stock for 200 shares times $12 cost, $2,400.
Okay, credit treasury stock, $2,400. That removes them from the contra equity account. What's next?
Step 2, you need to reduce the common stock account itself because these shares no longer represent ownership. You debit common stock, but only for the par value associated with these shares.
Back to the original par value. So 200 shares times $2 par. That's a debit of $400 to common stock.
Correct. Debit common stock, $400.
Okay. Step 3.
Remember when these shares were first issued at $10, $2 went to common stock, par. And the other $8 went to additional paid-in capital, APIC.
Right, the $64,000 total APIC originally included $8 per share for these shares.
Exactly. Since these shares are now being retired, you also need to remove the original APIC associated with them.
Mhm.
So you debit the original additional paid-in capital account for 200 shares times that $8 premium.
200 times $8, $1,600. So debit additional paid-in capital, $1,600.
Precisely. Debit APIC, $1,600.
Okay, let's tally that up. We have debits of $400 to common stock and $1,600 to APIC. That's $2,000 in debits so far. And we have a credit of $2,400 to treasury stock.
Doesn't balance yet. We have $2,400 on the credit side and only $2,000 on the debit side. We're short $400 on the debit side.
The balancing act. Where does that remaining $400 debit go? This is the plug, isn't it?
It is. This is step 4. Any difference needed to make the entry balance after removing treasury stock at cost and the related par value and original APIC. That difference gets plugged to retained earnings.
So in this case, since the cost, $12, was higher than the original issuance price, plus APIC, $10, we need a debit to make it balance.
Correct. The cost to retire, $12 per share or $2,400 total, exceeded the original capital contributed for these shares. $2 par plus $8 APIC, $10 per share or $2,000 total. That excess cost of retirement, $400, reduces retained earnings.
So we debit retained earnings for $400.
Exactly. Debit retained earnings, $400. Now your debits, $400 plus $1,600 plus $400 equal $2,400, and your credit, $2,400 balances.
Wow. So retiring shares bought back above their original issue price actually reduces retained earnings under the cost method.
It does. It reflects the fact that the company ultimately paid out more to retire the shares than the capital they originally brought in. It's the final reckoning for those shares.
That really ties the whole life cycle together.
It really does. If you connect this to the bigger strategic picture, understanding this full journey, issuance, repurchase, reissuance, and maybe retirement is just, well, essential for analyzing a company.
It's not just about the debits and credits, is it?
Not at all. It's about seeing why a company makes these choices and how they impact the financial statements, the equity structure, which leads to a pretty interesting question, I think. What strategic reasons might push a company towards retirement specifically instead of just holding or reissuing treasury stock? And what signals might that send to you as an investor?
That's a great question. Choosing retirement over reissuance feels more permanent, more definitive.
It absolutely is. Reissuance keeps the option open, maybe capture some upside if the price goes up. Retirement is a final decision.
So why do it? Maybe it signals extreme confidence, like, we have so much cash and our prospects are so good, we don't need this capital buffer, and we believe reducing the share count is the absolute best use of funds.
That's often a big part of it. It can signal a mature company shifting focus from growth funded by equity to returning value directly to shareholders through a permanently smaller share base. It can boost EPS, potentially increase the stock price for remaining holders.
It's a strong signal about capital allocation priorities. They're saying, buying back and canceling our own stock provides a better return than other investments we could make right now.
Precisely. It suggests management sees significant intrinsic value and is committed to enhancing shareholder value through capital structure optimization, not just operational growth. It's a deliberate, long-term move.
What a journey we've taken then. From a simple share issuance through the nuances of the cost method for repurchases and reissuances, handling those gains and losses carefully, right through to the finality of retirement.
We covered a lot of ground.
Yeah, we really did. We hope this deep dive has given you some of those aha moments, clarifying how these transactions work and, just as importantly, why companies might undertake them. It really shapes a company's financial story.
Understanding treasury stock truly opens up a deeper level of financial statement analysis.
Absolutely. So here's something to think about. When you look at a company's history of share buybacks, do they tend to reissue or retire? What might that pattern tell you about their long-term strategy, their view of their own value, and maybe even their confidence about the future? Food for thought.
Definitely something to consider.
Thank you so much for joining us on this deep dive. We hope you'll continue exploring and learning with us next time.